Hi, I'm Eric Schlein from Larchmont, New York. My question is directed at Mr. Buffett. Mr. Buffett, you claim you can do 50% a year. If you had to start over with a small portfolio, would you still be doing buy and hold, buying quality companies at a good price? Or would you be doing arbitrage and really getting down to the nitty-gritty Benjamin Graham cigar butts that you did in the Buffett Partnership?
If I were working with a very small sum, and you should all hope I'm not, if I were working with a very small sum, I would be doing almost entirely different things than I do. I mean, your universe expands. I mean, if you're looking, there's thousands and thousands and thousands of times as many options to think about if you're investing $10,000 than if you're investing $100 billion. And obviously, if you have that many, you got all the options you got with $100 billion, except buying entire businesses, and you've got all of these other options. So you can earn very high returns with very small amounts of money, and it will always be such.
Warren Buffett, the king of value investing, has built up quite a cult-like following over the years, and he's definitely been my investing idol ever since I started investing. Now, even today, I asked myself the question, if Warren Buffett was investing my money, what would he put the money into? So when I first started investing and I delved into the world of YouTube, I looked at all these videos and articles covering Warren Buffett's portfolio, what Warren Buffett bought this quarter, what he bought next quarter, and I thought, would it be a good idea if I just copied exactly what he did? And while it's not a bad place to start, I know now that if he was investing the small amount of money that I have, he would invest very differently from how he does now. Now, if you had $300 billion to invest, it would almost never make sense to buy any company that's worth, say, less than $10 billion. And here are 3 reasons why. Now, the first reason is it's not really worth it. If you managed to buy a company that was worth $10 billion and you had $300 billion, and let's say the value of your investment doubled, for most people, it would be incredible. But for you, that's a $10 billion gain, or about a 3% return, which is not that much to write home about. Now, another reason is daily trading volume. Let's just say that each day there was about $10 million of this stock traded, and the stock price was about $10. So this would mean that it would take you about 100 days to finish accumulating your position, which is about 4 months. Quite a hassle. And the last thing is, during this whole process, you could push up the stock by quite a lot to a point where it wouldn't even make sense for you to buy the company anymore. So here's what Warren Buffett had to say on the matter. Here are the exact quotes. If I was running $1 million today, or $10 million for that matter, I'd be fully invested. Anyone who says that size does not hurt investment performance is selling. The highest rates of return I've ever received were in the 1950s. I killed the Dow. You ought to see the numbers. But I was investing peanuts then. It's a huge structural advantage not to have a lot of money. I think I could make you 50% a year on $1 million. No, I know I could. I guarantee that. So the question to answer then is, if Buffett was managing your money, what would he put the money into? And recently I found something that might just help answer this question. And these are the Buffett Partnership Letters from 1957 to 69. When Buffett was 26, he had savings of about $172,000, which he got from a lot of areas, anywhere from selling pinball machines to selling Coca-Cola bottles to selling newspapers door to door to working, and from his investments as well. When Warren Buffett was 26, a family friend came up to him and asked, "Hey Warren, I want to invest with you. What I gotta do?" And Buffett thought about it a little bit and decided to form the Buffett Partnerships Limited with some close family members as well as close family friends. And the fund initially had about $105,000 in funds for Buffett to invest, and it's something sort of similar to a hedge fund these days. So every 6 months, Buffett would go and write letters for his partners, and these letters would have information on the overall performance of each fund, how Warren Buffett was thinking about the market at the time, and would also include some really insightful information on Warren Buffett's overall investment philosophy, as well as some of the investments that he made at the time. When you read through these investing letters, it's very interesting because you realize his investing philosophy hasn't really changed all that much. And Warren Buffett at the time, and to this day, still does not believe in diversification. And the reason behind this is he thought that if you had a portfolio of hundreds of different stocks, then you'll have some good ideas in there, some bad investing ideas, and mostly mediocre companies, so that it would produce a very mediocre return at the end. He compared it to Noah's Ark, which is a lot of big investing managers think that they have to be like Noah. They have to go to every industry and every different geography, and they have to pick out 2 companies of each kind. And Buffett thought that this was a recipe for mediocre investment performance. He also argued that if you have hundreds of stocks in your portfolio, that's hundreds of different companies, and you're not going to be able to know any of these companies very well. He kind of compared it to a harem, which is if you have a harem of 75 girls, you're not going to know any of them very well. Now, this is very interesting because whenever Warren Buffett is asked about his opinions on what stocks to buy, he always says, just buy the stock market index.
Do you have any stock tips for me?
Well, just between you.
Yes. It'll be our little...
The average person will not know enough to know which stocks to buy. They won't know enough to know when to buy them, but they don't have to, because if they can buy all of America through an index fund, and then they just have to be sure they don't jump in at exactly the wrong time, and they won't know what's exactly the wrong time. So therefore, they should put their money in over a period of time, and they'll have some periods that are wonderful and some that weren't so good, but overall, they will do fine over time.
But from these partnership letters, it's clear that if he was investing your money, he would not be putting any of it into an index. In fact, his top 5 or 6 positions make up about 60% of the overall portfolio value that he's managing, and the rest of the money is split up between 10 to 15 stocks. In fact, in these letters, Buffett says that if he finds an investment opportunity that has a very high chance of delivering a really good return with not a lot of risk, he will put up to 40% of all of the money he's managing into that one stock. Something else that hasn't changed at all from Buffett's philosophy is his focus on companies whose earnings he could reasonably predict over time. He wanted to stick to companies that he could understand very well. And there was a part in the letters where he was addressing a question someone posed to him, which is why he wasn't investing in semiconductor companies at the time, which were really hot. And Buffett said, because I can't predict the future earnings of those companies very reliably, versus a bank or manufacturing company or something else that he understood better. Another really important principle that Buffett lays out is not following the herd. And there was somebody who questioned Buffett in the letters, and Buffett responds. And that person asked Buffett, why are you not investing in all those big blue chip names like HP, Kodak, IBM? Those were the big well-known companies at the time, kind of similar to how Facebook and Amazon are today. And Buffett replied by saying, look, if you have these blue chip companies and every single hedge fund is investing in these companies, it's going to cause the value of these companies to go way above how much they should be worth. And just because a lot of really smart people agree with you in buying these companies, it doesn't mean that you're going to be right in the long run once these prices correct. And Buffett talked about the fact that even though he was invested in a lot more less well-known names with a lot smaller market caps, because he invested in these companies and he bought in way below how much he thinks that these companies should be worth, when the market goes down, his fund will go down a lot less. And in fact, there's been quite a few times when the stock market went down and his fund actually went up during that same time. So to achieve market-beating returns, it's very important to not follow the herd. And this leads me very nicely to the last factor of Buffett's investment philosophy, which is how he viewed his performance. He viewed a year when the market was down 40% And his fund, if it goes down 20%, he would consider that a really big win because his fund outperformed the market by 20%. And he would view a year where the market grew 30% and his fund grew 35% maybe. He wouldn't view that as good of a year as the previous example. Now, he goes over this over and over because this wasn't very intuitive to grasp for his partners and probably isn't intuitive for the average person to grasp. But Buffett talked about how he expected to see his best performances on years when the stock market didn't do that well. All right, let's get to the exciting part, which is Warren Buffett's investments during this period. During this period, Warren Buffett mainly focused on companies that were worth between $8 million and $80 million. And these are certainly not companies that he would be able to invest in today. The first category of investments that Warren Buffett made was in a category called generals. These were companies that Warren Buffett figured out was trading at a huge discount relative to how much they were earning, how much they were expected to earn in the future, as well as the current assets that these companies held. One interesting thing to note here is Buffett would often try to look for not just cheap companies, but companies that had a management or group of people, shareholders say, who want to initiate change in the companies so that the value of the company's assets or the value of the company's earnings could be recognized in the near future. Buffett referred to this practice as riding on the coattails. So one example of an investment that Buffett made in the generals category was in a company called Commonwealth Trust of Union City. This was a bank, and Buffett understands banks really well to the point that he can actually project out the earnings of a lot of banks. And this bank he found had really stable earnings, and he believed the company should be trading at least $125 per share. In reality, the company at the time was only trading for $50 per share, and that was because the company didn't pay a dividend, and that was what was causing the value to be compressed so much. And Buffett knew that there was another bank that owned 25.5% of Commonwealth Trust of Union City, and sometime between 1 year and 10 years, this larger bank was going to buy out the smaller bank, and during that time, his investment is going to be realized. The other category of investments that Buffett looked to was a category called workouts or arbitrage opportunities. This was a case where Buffett was trying to profit off of some sort of corporate action, such as a merger or a liquidation or an acquisition. One example of one of these investments is a company called Texas National Petroleum. It was announced in the paper that a California oil company was going to buy out this company for about $4.25. Immediately after the news is announced, the shares go to about $3.50 per share. Now, Buffett analyzes this opportunity and figures out that there's a very low chance of this acquisition not going through. The transaction was negotiated by the major shareholders of Texas National Petroleum and the California Oil Company. The government was not likely to step in or do anything, and the only thing that might stop this transaction from taking place is something to do with taxes, which could easily be resolved. So Buffett buys a lot of this company for $3.50 per share, and eventually, once the takeover happens and the company gets acquired for $4.25 per share, Buffett makes a good 20 or 25% return. Normally, Buffett would allocate about 25% of all of his money that he's investing into these workout or arbitrage opportunities. Arbitrage opportunities are pretty significant in the fact that they're very rarely correlated with the market, which means that in a year where the Dow Jones or the overall stock market goes down, the arbitrage opportunities will still go up, which makes it a good protection against a market downturn. So the last category of investments that Warren Buffett makes is in a category called controls. Usually these start out in the generals category, and then Warren Buffett starts buying more and more and more of this company until he's the controlling shareholder. And normally he does this when he feels like the management team isn't doing enough to realize the value of the investment. So he goes in, takes a controlling position. If needed, he will either put pressure on the existing management or he will fire the management and bring in somebody else who can then make sure that the company's value corrects to where it should be. Once a company becomes within the controls category, it then becomes independent of what the market thinks, because Buffett has the ability to initiate any kind of action in order to help the company realize its value. So one of the examples of Buffett's investments in the controls situations is through a company called Dempster Mill. So Dempster Mill was a run-of-the-mill manufacturing company. They made farm implements as well as water drainage equipment. And Buffett looked at this business and saw that its stock price had gone down by quite a lot in the recent years. And that was because the management wasn't very good. They were allocating capital in a way where they weren't getting many meaningful returns, and the profits on the business were really stagnating. So people were really pessimistic about this business. And Buffett came in and he saw that the book value of the company, which is their assets minus the liabilities, was about $75 per share. And he saw that the company was trading at a really big discount to book value. Buffett bought the company for about $28 per share. And before buying, he valued all of the assets as if they were going to do a fire sale. So he discounted areas like inventory by around 40%. And he found out that if they were to do a fire sale of the assets, they could probably fetch about $35 per share. So he bought in with a big margin of safety, and afterwards he hired another person in management, Harry Bottle. And Harry Bottle came and did a complete change in the business. So the old management was gone, and Harry Bottle came and allocated the capital to much more profitable areas. So he took the money that was being fed into a business that wasn't generating many returns, and they allocated the money instead to securities. They sold off a bunch of unprofitable businesses, and they also cut costs by a lot, sold off a lot of inventory, and restructured the business to a point where within a few years, they ended up selling the business for $80 per share. Now, another example of a control situation was a company called Sanborn Map. So Sanborn Map was around in the days before Google Maps existed. So these were very detailed maps of different cities and streets and had a bunch of detailed information there. And insurance companies use these maps in order to underwrite insurance premiums for, let's just say, fire hazards. And this business was really struggling. When Buffett was looking at it, its profits had plummeted by 80% because of a new insurance policy underwriting procedure that didn't require these maps. But Buffett saw a very interesting trend, which is in the 1930s or so, the stock for this Sanborn Map company was selling for $110 per share. And they had an investment portfolio that was worth $20 per share. Now, in the 1950s, the mapping business, the profits declined significantly, but the value of the investment portfolio actually grew to $65 per share. And in the 1950s, because people were so pessimistic about Sanborn Map, the stock price was only $45. So Buffett came in and bought up a ton of stock in this company, and then he initiated a corporate action to make it so that the value of this business was going to be recognized. So he told all of the shareholders that if they wanted out, and the stock was trading about $45 or so, if they wanted out of the stock, then Buffett would give them the value of the investment portfolio. So that means that they could sell their $40 shares for $65. And what that led to was a ton of shareholders, about 57% of them, sold all of their stock. And that meant that the overall earnings per share went up a lot because the shares outstanding that was available went down by a ton because Buffett bought back a ton of stock from those existing shareholders. So that was an action that he used to help realize the value of his investment. So what can we as retail investors learn from a younger Warren Buffett? I think it's important, first and foremost, for us to focus on small cap companies. So companies that are trading between $8 million and $80 million. And that's because these companies are so small that big hedge funds and banks, it doesn't make sense for them to look into this area. So there's more likely to be opportunities for mispricings where a company is trading a lot below than where it should be. The second thing is to look for opportunities where the companies that you're buying are very discounted compared to the future earnings they can generate, or if they can't generate much future earnings, at least they have a lot more assets for the price that you're buying it for. And the last thing is to look for future corporate events for the companies you're investing in that can help the mispricing to be corrected. Whether or not there's a shareholder group that's trying to initiate a spinoff or a liquidation event in order to make it so that the assets of the company or the future earnings of the company are reflected in the future price. Thank you so much for checking out my video and my channel Green Bean. If you enjoyed this video, please give it a thumbs up, like, subscribe, whatever helps the YouTube algorithm. My goal is to get to 1,000 subscribers so we can start making these videos full time for you guys. All right, cheers. See you all in the next video.